The 10 best underrated stocks to invest in 2022. Hello and welcome to Market Technology Flex. In this video, we're talking about the 10 best underrated stocks to invest in 2022. Recessions make the rich richer and the poor poorer. Why? Rich people know how to take full advantage of the economy and its cycles, while the poor get swept up by a market they don't even see. You know how rarely we do stock videos, and what happened the last time we did one of these was, so pay attention. By the end of this video, not only will you have a list of 15 stocks that we're investing in right now, but you'll also better understand how to move from being an observer of the markets to an active player. The best time to invest is when there's blood on the streets. That's a metaphor for the entire stock market looking red. We'll keep this video as beginner-friendly as possible, especially since this isn't financial advice. It's just keeping you guys up with how we're moving some of our money around in times like these. Number 1, Airbnb. The Airbnb price right now is $119 per share. The company is down 44 in the last 6 months and is currently trading under $120 per share. We bought our first batch at $113 per share, but will consistently gain more and more of all the stocks mentioned in this video in the following weeks. This was a company that was supposed to get annihilated by COVID, and they still brought in $6 billion in revenue last year. Tech companies have been crushed lately, but the underlying business is valuable and good. We use Airbnb. We think their product is continuously getting better, and we see them as a massive competitor to the entire hotel industry. In terms of the next 12 months, we don't expect the stock to stay under $200 a share, giving investors at least a 50% return. This is a company that we love, with a product we use, with a vision for the future, and with over $2 billion in free operating cash flow. Number 2, Adobe. Adobe's price right now is $395 per share. Adobe is a lot bigger than that PDF reader you have on your computer. Photoshop, Illustrator, Premiere, After Effects, and many more are by far the most popular tools of the creator economy. This video is edited on Adobe software, as are most all videos on the majority of logo banners, anything digital for that matter, all touch Adobe at some point. Same as with Airbnb. Adobe is down 42% in the last 6 months and is currently trading at under $400 a share. And even better than Airbnb, Adobe has been making money year after year since we became investors in 2017. This is a highly profitable company in a space that's growing faster than ever before, with products that are constantly getting better. 12 months from now, we're expecting at least a retreatment back, which will provide investors with at least 40% returns. With the rise of Web3, digital will explode, and we're betting hard on companies that will play a part in creating this new market, which brings us to the next company. Number 3, Nvidia. The Nvidia price right now is $166 per share. Most people might not understand it, but the metaverse is coming. Actually, it's already here. All of it will run on graphics processing units, or GPUs. These are in every computer out there, and it what allows your computer to generate visuals. Nvidia is one of our superstars. Everything we see coming will rely on the software they produce, and that includes gaming, AR, VR, and metaverse worlds. These niches are growing exponentially faster than anything else around, and GPUs are essential to all of them. The Goliath in this space is Nvidia, and there's no way they will not make bank in the next decade. Stock-wise, we follow the same market pattern. Share price is down 46% in the last 6 months, and it's currently trading around $166. This is a company that has an average 36% profit margin and is bringing in over $25 billion in revenue this year. There's no reason for the huge discount we're seeing on the share price right now, so we're taking advantage of it. Best case scenario, you're doubling your money in the next 12 months. Worst case scenario, the stock will be around $160, so not much to lose. We can't wait to see if we're right about this one, especially since the next company is leveraging Nvidia's tech. Number 4, Unity Software. Unity is one of our more aggressive plays in every portfolio. You should have a few of these that have the potential to outpace everything. There are 2 massive players in the world of game engines: Unreal Engine, which is now owned by Tencent, the Chinese company, and Unity. Although Unreal has unlimited money available, Unity is the underdog that's been able to hold its own. Their software holds for ultra-realistic graphics. What you see on the screen right now isn't an actual human. We believe that in the next decade we'll cross into what is called the uncanny valley, a point in technology where you won't be able to tell if what you're seeing is an actual human or if it's computer generated. Unity is playing a big role in that, so let's talk about financials. Unity is down a whopping 82% in the last 6 months, with the price trading above $30 a share. From our perspective, this is a perfect asymmetric risk situation that has the potential to provide incredible returns for investors in the next 12 months. The company had $321 million in sales in the first quarter, which is ballpark what they spent last year to gain Parsec. This might be famous last words here, but Unity is probably going to be fine. Number 5, Nike. Nike's price right now is $109 per share. Bet you didn't expect to see a shoe company on this list, but hey, if it makes sense, it makes money. We love Nike. We buy products from them. We enjoy their products and they're part of the culture. You should own shares in the companies that make the products you love that don't sell unless their products stop fulfilling your needs. As long as you remember this rule, you'll be fine in the investing world. Nike is iconic, but despite their size, brand power, and reputation, they got caught up in the market crosswinds with everyone else. They're down almost 40% in the last 6 months, and for a company that's consistently growing sales year over year, a company that brought in almost $45 billion in revenue last year. When all this charade eventually fades, the stock will recover because any business that has this kind of brand loyalty will definitely pull through. 12 months from now, look at 50% plus returns on your investment in Nike. Number 6, Under Armour. Under Armour's price right now is $11 a share. We jumped in April 2020 at $8 per share and liquidated our position last October at $21 a share. We feel like now would be a great time to jump back in. The last 6 months, Under Armour stock is down 60%. They're a great company, and as with everything else on this list, we enjoy their products. We love the underdog position and how creative they have to be to keep up with the big boys like Nike and Adidas, and they're doing great. They're able to remain competitive by having a smaller profit margin at 6% compared to that of Nike. For example, that's at 12%. This is the play you make when you want to penetrate the market and build up the brand. $5.6 billion in revenue doesn't lie. In terms of 12-month projections, we expect the stock to return to somewhere in the $20 range, at which point we might consider partially liquidating our position. Number 7, PayPal. PayPal is priced right now at $76 per share. PayPal is one of those counterintuitive bets. It's too tech for old people to care about, but too old tech for the Web3 kids to find it cool. PayPal is no longer a cool business, but it's still making a ton of money and growing in users. Most people don't realize that 22% of all online transactions in the United States are handled through PayPal, and even with all of that, the company crashed 65% in the last 6 months. The all-time high was $300 per share only 10 months ago, and at the same time, the same share is trading around $75 today. This is a company that brought in $25 billion last year and is growing everywhere around the world where more and more people get access to online marketplaces. Do you know about Venmo? Do you use Venmo? Well, PayPal actually owns it as part of its payments ecosystem. With e-commerce on the rise with online access quickly entering markets we've never had before, we think PayPal has a pretty good strong case to stay. Number 8, Square. Square's price right now is $78 per share. From one payment processor to the next, we love betting on multiple players in the same industry because if we feel like the industry is expanding, it doesn't matter if you pick the right horse. Square is the brainchild of one of our favorite entrepreneurs, Jack Dorsey, the founder of Twitter. In the past 6 months, Square is almost down 70%. We began investing in Square in the middle of 2020 at $85 a share. As their growth began and because we are constantly restructuring our portfolios, we fully exited the position at the end of October last year at $265 per share, making it one of our best investments to date. And now that the stock is back under $80, we'll want to go on that ride again. The company is making bank, and with Elon taking over Twitter, Jack is more focused on Square, and honestly, we're expecting at least a 2x from where we are today in the next 12 months. Number 9, Spotify. Spotify is another one of those companies that we've had in our portfolio. We entered at $150, exited at $250, and forgot about it. When this tech crash came around, we checked our favorites, and lo and behold, Spotify was trading at under $100 a share. Last year, they took $1.5 billion in financing, and the company is looking a lot better on paper than the markets would make you believe. And yes, they're one of those companies that lose a little money every year, but the number of paying users is growing year over year. Spotify has gone up against Apple and Google, and they still made a name for themselves. We think they're a viable candidate for 50% plus returns in the next 12 months. Number 10, Coinbase. Coinbase's price right now is $66 per share. We're going there because this might end up being the best trade in this entire list. Coinbase, the largest regulated crypto exchange in the United States, is trading at $66 per share, down from $350 back in November. The stock is down 80 in the last 6 months. Now, this is a super fast growing business in an emerging sector that's making between 25 up to 50% margins, no matter if the price of crypto is up or down. Exchanges don't care about the price of the coins transacted on the platform, as they make their money on commissions on said transactions. The number of users is going up, revenue is going up, profits are going up, yet the stock is tanking. The profit-to-earnings ratio is 5.6 for those of you who are into financial analysis, and that's insanely good. Apple, for example, has a P/E ratio of 23 to 1. By this point, you know we believe crypto is here to stay. We're accumulating there as well. This is an opportunity for those of you who want exposure to crypto but don't want to get caught up in all the wallets, coins, and exchange environments. Once this crypto bear market is over, we're expecting Coinbase stock to trade above $200 a share. This actually might be one of those moments where stock investing could be less risky and more profitable than crypto. Thanks for watching and subscribe.